Hi, this is LW Global Finance. Welcome to today's deep dive into the global markets, where we break down the stories that move the economy, Wall Street, crypto, and more.
Okay, so our mission for this deep dive is really trying to make sense of the market's almost cognitive dissonance lately. We saw this massive volatility, right? Global markets plunging last week, all driven by U.S. China trade talk fears. And then suddenly, a Sunday social media post just says, "Don't worry, it will all be fine." And markets, well, they reversed instantly. Can we even call that a relief rally? I mean, the thread Friday was a huge 100% tariff. Was it really solved by, a single post? It seems confusing.
Exactly, and what's really fascinating here, I think, is getting past just that immediate noisy reaction. So we're going to unpack three key things for you. First, what that volatility whipsaw really tells us about maybe deeper fears. Second, who is actually paying the price for these tariffs? Because there's a lot of debate there. And third, how central banks are trying to juggle, supporting jobs while keeping a lid on inflation risk. It's a tough balance.
Right. Let's jump straight into that Monday reaction then. It was a big rebound. You had the S&P 500 rallying, 1.6%. The NASDAQ jumped even more, 2.2%.
A huge number.
Yeah, and the MSCI Global Index was up almost 1%. All apparently because of this softer tone and news that the Trump-Xi meeting is still on the cards.
But here's the really interesting part, the sort of paradox. If you looked closer, the fear didn't vanish. Not really. Sure, the stock market seemed to buy the tweet, at least for a day, but gold prices hit a fresh record high, reached $4,100 an ounce, even as stocks were rallying.
Wow, $4,100, so the safe haven trade was still very much alive.
Absolutely, and it tells you there's this deep underlying uncertainty. Look, BofA Global Research just upped its 2026 gold forecast to $5,000 an ounce.
5,000, okay, that signals some serious long-term concern.
Definitely.
So let's pivot to the tariffs themselves, the central debate, really. Policymakers predicted, quite explicitly, that foreign exporters would just absorb the cost, right, to keep selling into the U.S.
Yeah, that was the prediction. But it turns out that wasn't quite right. Actually, it was pretty wrong. Academic studies have looked at this closely, and they prove the opposite is happening. It's U.S. firms and ultimately U.S. consumers who are bearing the brunt.
How do we know that? Is there data?
Oh, yeah. The data is quite clear. Prices for imported goods up 4% since the tariff started, but comparable domestic goods only rose about 2%. So you see the gap. Foreign producers aren't really eating the cost, they're passing it on.
So it's hitting American buyers directly in the wallet.
Pretty much.
And it's not just a domestic issue, is it? These tariffs are hurting global trade flows overall.
Massively. The World Trade Organization, the WTO, they've slashed their forecast for global merchandise trade growth next year, slashed it down to just 0.5%.
0.5% growth, that's almost stagnant.
It's a huge slowdown. These trade barriers are really starting to bite globally. And, this pain, this cost pressure feeds directly into the inflation problem that the Federal Reserve is grappling with.
The Fed's tightrope walk.
Exactly. Their policy rate is sitting at 4.00% to 4.25% right now, and they're split. You've got officials like John Williams arguing for more rate cuts this year. They're worried about risks to the job market.
Okay, so that's the dovish side, because there's pushback.
Yes. On the other hand, you have people like Philadelphia Fed President Anna Paulson. She's signaling basically unwavering vigilance on inflation. Her message is clear. They are ready to react to a burst of inflation to keep it near that 2% target, even if fighting inflation risks slowing down growth.
So they're really watching those price numbers closely. How much have the tariffs actually added to inflation so far, though?
Well, the Fed's own economists estimate it's been relatively modest on the overall price level, maybe about 0.25% to 0.5%.
Seems small in the grand scheme.
It does seem small now, but the risk is that it becomes embedded, that expectations shift and inflation becomes sticky. That's the central bank's big fear. That's why they're staying so vigilant, even hawk-eyed.
Right, so pulling this together for investment, what we're seeing is market moves that are incredibly sensitive to, political tweets and rhetoric. Meanwhile, the actual economic cost of the trade policy is quietly trickling down to businesses and consumers.
And that disconnect, that geopolitical uncertainty, it's really starting to influence investment strategy where the big money flows. It's interesting, despite the U.S. market holding up, relatively speaking, Deutsche Bank just upgraded European equities to overweight.
Oh, interesting. Why Europe now?
Their reasoning, primarily cheap valuations. They basically expect Europe's 15 years of underperforming the U.S. market might finally be ending. Investors might be getting tired of paying high prices for U.S. assets given all this uncertainty.
So a potential shift away from the U.S., driven partly by this trade noise and valuation fatigue.
Could be. It's definitely something to watch.
Okay, so we've seen tariffs are complicated, they're costly, and political talk drives this wild short-term volatility that doesn't seem to help much. It really leaves you with a final thought, doesn't it? If central banks, like the Fed, are now signaling they're willing to risk a slowdown, maybe even a recession, to stamp out sticky inflation, how much longer can all this geopolitical uncertainty keep pushing the price of something like gold higher and higher? Where's the breaking point?
Thanks for tuning in to LW Global Finance. What's your take on today's market moves? Leave a comment, share your thoughts, and don't forget to follow us for more updates and analysis.